Welcome. Good morning, good afternoon, good evening, and thank you guys once again for joining the 9 Innings podcast hosted by yours truly, Kevin Thompson, founder and CEO of 9 Innings Capital Group. Thank you guys for joining us. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple Books. If you have any questions, comments, or concerns, you can always go to the website at 9inningscapitalgroup.com, schedule an appointment, or you can email us at 9innings@9icapgroup.com. Send us a message to see if you have any questions, comments, or concerns. You want to listen to our YouTube channel, you go to YouTube and type in 9 Innings Podcast and subscribe to that channel. And if you want to listen to it via audio, just go to iTunes or SoundCloud and type in 9 Innings Capital Group there and subscribe to that channel. Today, people are often asking us, or asking me, Kevin, are we headed to recession? Are we headed to a slowdown in our economy? Well, I'm here to do what? To educate, empower, and engage. And today we're here to talk to you about, are we headed to a recession? Let's get it. So the question remains, are we headed to a recession? And let's talk about the definition of what a recession actually is. Now, what Wikipedia says, and I'm going to read it directly from Wikipedia because I don't want to get it wrong. Wikipedia basically says that it is defined as a significant decline in economic activity spread across the market lasting more than a few months. Normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. So let's break this down nuts and bolts. Are we currently in a recession? Well, let's see. Let's start with real income. Wages have actually gone up. We all know this. People are no longer getting the $7 an hour, the $9 an hour, the $10. People are actually getting $15 an hour, $20 an hour, what have you. But what is offsetting that? Inflationary pressures are offsetting real incomes. So even though you've gotten an increase from $10 an hour to $15 an hour, real incomes are not moving higher because inflation is that much more potent. So has it gone down? Has real income gone down? No, but it hasn't risen. It hasn't risen because of inflation. So you can almost sit here and say that it's been steady to basically sort of declining, but it hasn't declined materially. So real income is, I would say, in my humble opinion, from an economic standpoint, real income is basically declining because inflation is that much more potent. Employment has not gone down. It's actually gone up. People are getting jobs. There's tons of jobs, but out there for individuals to receive or to apply for. So jobs are prevalent. People have resigned from the workforce, or people are actually using their bargaining power to get hybrid work, to work from home and work at an office. So employment is steady, and they're creating jobs. There's going to be a lot more government jobs coming up as well because of IRS and things like that. The government needs people to enforce the tax law. So with that being said, jobs are steady. Industrial production is one that we can all agree on, that supply chains have slowed that to a crawl. That's not to say in the future that it won't come back, but as of right now, due to the pandemic environment, people not going to work into these factories, creating the widgets to make the end products, industrial production has calmed down. Albeit it hasn't stopped. But since the demand is still out there due to hotel retail sales, demand is still out there because retail sales have gone up. Production of those products, the end products, have gone down. And of course, real GDP remains steady. It's maybe possibly slowly increasing, but again, it may increase at a slower rate or a lower rate here in the future. So are we in a recession? According to the actual definition of a recession, those endpoints, those analytic tools that are telling us if we're in a recession, the answer is no. We are not in a recession. The other question we have to ask ourselves from a recessionary standpoint is, well, Kevin, if we're not in a recession currently, what would you say would be an indicator of a future recessionary environment? And I'm going to put this side by side. So what you're seeing right now is what we call the yield curve. The yield curve is interest rates across all maturities, all government maturities. You're seeing 3 months all the way out to 30 years. In general, this is an upward sloping yield curve. What you're seeing right now, the purple line, as you can see, was sort of inverted in nearer dated maturities, but it was upward sloping in longer dated maturities. That was in 2020. In 2013, look at it now. December, upward sloping. The caveat I wanted to tell you about is anytime it gets flat or it begins to invert, 6 to 9 months later, a recessionary environment ensued. So what you're seeing currently here in 2022 is that the yield curve is starting to invert. So we talked about the inputs: industrial production, real income, GDP, employment. Now we're going to some of the analytics behind it. Is the yield curve starting to invert? And the answer is yes. Not materially, but this is more of an indicator that once it begins to invert and materially inverts, in general, a recession ensues. So, Kevin, here's a question you're going to ask me. Kevin, well, if we're going into a recession, what does that mean for the stock market? Well, I'm not saying we're headed into a recession. I'm saying some of the indicators may say we're headed into recession. Not to say that we're headed there, because we have a lot of good inputs. Employment's still high, all these different things. However, I'm just giving you some of the market internals. So let's talk about bear markets and some of the, I guess, the inputs to a bear market. I want you to focus not on the left-hand side, which is showing you a bunch of market corrections. We all know these market corrections: the 1929 market correction, tech bubble market correction, the global slowdown, financial crisis. We all understand what a correction is. A correction is 10% plus 10% minus in a certain index. A bear market is 20% decline in an index. And these were all 20% declines in the index. So, is there a bear market approaching? Well, a lot of people think that we just got out of a bear market. The NASDAQ reached negative 20% recently, but it rebounded rather quickly. The S&P and Dow Jones almost reached those levels. They reached 15-16%, but they rebounded rather quickly. So, although these markets have corrected, are we headed to a bear market? So I want us to focus mainly on the environment. What kind of environment are we in? As you can see, some of the inputs to a bear market look like this. You have recessions, commodity spikes, aggressive Feds, and extreme valuations. So let's talk about today's market. Are we in a recession? The answer is no. We are currently not in a recessionary environment. There are some inputs that are negative, but we are currently not in a recessionary environment. Do we have a commodity spike? Ding, ding, ding. Oil, wheat, nickel, all of these different commodities have spiked in price. Lumber, coal, natural gas. All these different things have spiked. So there's a checkbox in that. And for 2022, do we have an aggressive Fed? Ding, ding, ding. The Fed is tightening right now. They just raised 25 basis points. That's not necessarily a tightening environment. The tightening environment is going to come next month when they talk about stopping their bond purchases and talking to you about what that really looks like. That's when they start to tighten. A 25 basis point is not an aggressive Fed. Bond buying, bond purchasing, and stopping that is an aggressive Fed. So that is around the corner. So the Fed being more aggressive is around the corner. So ding, ding, ding. Extreme valuations. Valuations were extreme when the S&P was over 21, 22 times forward earnings, forward PEs. Now, since we've had a correction in the overall markets, they've come down more than around 19, 18 times. So it's not necessarily extreme from a valuation perspective. So let's remove the recessionary environment and extreme valuation environment and focus on the middle two. We have a commodity spike and we'll have an aggressive Fed. Those two things in general lead to lower markets in the near term, not longer term, but in the near term. We're talking about near term right now. You guys all know our philosophy here. Our philosophy is long-term investing. Our philosophy is making sure we remain diversified across all different asset classes and not worrying about the near term, because when we get that 20 to 25% decline, those are buying opportunities. Why are they buying opportunities? Because it has been proven over a longer time frame that the markets generally will remain positive. It doesn't mean it will happen, but there's a large percentage of the time that it does happen. So the moral of the story is, Kevin, are we headed to a recession? Some of the inputs are telling us yes, but not all of the inputs. Employment still remains very, very low in regards to the employment rate, which is good. GDP is remaining steady, maybe slightly growing, but it may grow slower over the next couple of quarters. Real income, I can say real income and wages have actually come down due to higher inflation. Industrial production, the supply chain has caused a real hiccups in industrial production. With industrial production, hotel retail sales remains positive. People are still spending money. So are we headed to recession? Not yet. No. As long as the yield curve remains relatively flat to upward sloping and doesn't materially invert, I think we're okay there. It doesn't happen all the time, but in general, it happens more times than not. And in regards to the commodity spikes and the aggressive Fed, that is happening and that will happen. That may push us into a bear market, which we've already seen in the NASDAQ. But it's important to talk to your financial advisor about these things if they're concerning. It's important to have a conversation with your financial advisor to know that they're up on the economics around not only markets, but your portfolio. Thank you guys for joining us. Thank you guys for listening. As you all know, we're here to do what? Educate, empower, and engage. And today we talked about, are we headed to a recession? And we don't think so, not at this present time. If things change, we'll have another podcast to talk to you about why we're in a recession. But as of right now, no, we're not headed to a recession. Markets are looking good. Markets are looking stable. We just need to make sure that this Russia-Ukraine conflict ends peacefully. The U.S. and China talks are peaceful, and we get more of a global collaboration on good for everyone. I know that's more of a a pipe dream, but at the end of the day, if we're not dreaming, what are we doing? So thank you guys again. We appreciate your time. Thank you for listening to us, because you know we're here to do what? Educate, empower, and engage. And we talked to you today about if we're headed to a recession. If you have any questions, comments, concerns, call us or email us at 980s@9icapgroup.com. Stay humble, stay safe, and we'll see you